And welcome to everyone to today's presentation. I'm Al D'Augusto, co-founder of Retirement and Money Strategies. We are an independent financial advisory firm located in Avon, Connecticut. Our intention for today's presentation is to have you walk away with a better understanding of the options available to you beyond the traditional approach to paying for long-term care. Now, to help us better understand your options, it's my pleasure to introduce Dave Corliss, Regional Director of Long-Term Care for Pacific Life in the New England region. Dave is originally from Hatfield, Massachusetts, and he brings nearly 2 decades of knowledge and experience when it comes to long-term care. So without further delay, Dave.
Great, thank you, Al, and thank you, Josh, and good, I guess it's technically good afternoon, everyone. I appreciate the opportunity to speak with you today and review some information on long-term care. This is what I get to talk to folks about day in and day out, and I feel pretty strongly about what we do in terms of helping educate folks on what their options are. I found that in my travels and the conversations that I have, a lot of times people aren't quite aware of all the different options that are available to them, or if they are at least understand that there are options, they may not completely understand some of the pros and cons of each. So that's what we're going to do today. And as Al mentioned, our goal is that you walk away with a better understanding, but also that you walk away with an understanding of how important it is to have a plan. A lot of times folks kind of roll the dice and hope for the best, and that's not always the best approach. So we'll go through just a high-level overview of what is long-term care, and then some of the different options available, pros and cons to each. I would encourage you all that if you have questions, jot them down. I'm happy to answer any question that I can to the best of my ability. And if I don't know the answer, I will let you know that, and we'll get that back to Josh, and he can forward that on to you. So I will go ahead and share my screen. Let's see here. Okay, Al, can you give me a thumbs up just to make sure everyone can see? Okay, very good. All right, so we'll go ahead and get started here. So we'll start with a quick definition of what is long-term care. So this is professional health care services if you develop a chronic condition or illness and you're unable to perform 2 of 6 what we call activities of daily living, which include eating, bathing, dressing, toileting, continence, and transferring for a period of 90 days or longer, or you have a cognitive impairment that is severe enough to require supervision. That's the definition of being chronically ill. And it's important to establish that definition because when you have a long-term care policy to protect against this risk, you need to meet the definition of being chronically ill in order to trigger benefits. So again, it's the 2 of the 6 activities of daily living or the severe cognitive impairment. And that's going to be certified by a licensed healthcare practitioner. Could be your own physician that certifies that, but that's what we need in order for benefits to be paid out. Now, a chronic illness is something that you could recover from, right? It could be a car accident, a slip and fall, a ski accident. It doesn't have to be something that is always related to older ages and the fact that we tend to slow down from a health perspective. So you could have something permanent like Alzheimer's, dementia, ALS, something like that. But again, it could be something more episodic in nature where you will recover and get back to normal health. So some types of long-term care, typical types would include in-home care. That's where most people are getting care today. And depending on the plan, friends and family may or may not be able to be reimbursed for providing that care. So we'll talk a little bit more about that. Care provided in an assisted living facility, certainly a nursing home, community care centers, adult daycare. That's something that's getting increased popularity, if popularity is the right term to use. More and more people are taking advantage of that, and then certainly hospice care. Some factors on long-term care incidence. Certainly age is an issue, right? Just as we all get older, we might tend to slow down from from the physical capability perspective. We also see things like Alzheimer's and dementia. You have an increased incidence. I believe today, according to the Alzheimer's website, at age 65, it's either 1 out of 9 or 1 out of 10 will be diagnosed with Alzheimer's. And when you get out to about age 85, I believe it's 1 in 3. So certainly the incidence of Alzheimer's will increase with age, which could lead to the need for long-term care. Health and family history can contribute to that, as well as gender. Probably not a surprise to anyone on the call today that women tend to live longer and also go on claim longer than men usually do, at least historically. So that can play a role in the incidence as well. So one of the things that comes up a lot when I'm having conversations with financial advisors like Al and their clientele are some of the misconceptions. For example, Medicare and Medicaid. Medicare, generally speaking, is not going to cover long-term care. Now, there are some scenarios where it could for a limited basis, and that's involving a situation where if you're in the hospital for 3 days as an admitted patient, not observation, but an admitted patient, and you're discharged to a skilled nursing facility, or you enter a facility, I believe, within 30 days, Medicare will cover the first 20 days 100%, and then up to the next 80 days with a copayment that is currently around $170 a day. Medicaid is going to be there to help those who don't have the financial means to cover the costs themselves. So those are not typically going to be, the first line of defense, if you will, or plan A or plan B. Health insurance, that's going to cover your doctor's visits, your hospital stays, things like that. More acute situations, it's not there to cover long-term care. And disability is really to provide benefits for loss of income should you find yourself sick or injured. It's not a solution for long-term care. So really the options are long-term care insurance or self-funding. And again, we're going to go through some of the different options for long-term care insurance. But if you do have questions regarding Medicare, I would highly suggest that you do a quick Google search on Medicare and You. This is a paper copy of the brochure. There's PDFs available online, and they update it every year. So it's a very easy way to just get a better handle on what Medicare will and will not cover. One of the questions that I get is around level of affluence or wealth, and if I've got a lot of money, what do I want long-term care, and does it make sense, and why should I? And we do find that a lot of folks who have significant levels of assets are still purchasing long-term care, and they're doing it because they understand there's a better way to pay for it. Because when you've got some sort of long-term care insurance, you're really just leveraging your purchasing power. So if you or someone you know is in a situation where you've got a pretty strong financial portfolio, this still might be of interest to you. So when we think about why people like to self-insure and some of the things that they have to take into consideration, it's things like which assets would you liquidate first, right? And that's typically going to be the assets that are the most liquid, have the least growth potential, and have the least tax exposure. So that's generally things like cash or cash equivalents. What's the cost of liquidating these assets, right? So we need to take into consideration things like market volatility, something that Al, I'm sure, is seeing phone calls and emails today from lots of clients based on what's going on literally today. So you've got market volatility. You've got what we call sequence of return risk, meaning do you have negative or poor returns leading up to when you need to start liquidating? And then there's certainly taxation, right? What kind of tax environment are we in? What will be the impact to your retirement lifestyle and maybe your loved one if you have a significant other or a spouse or even children, right? What's the impact going to be in terms of what's meant to go to them as well? So all those things come into consideration. And for a lot of folks, that's one of the reasons they buy the long-term care is they want to preserve as much of their wealth for the beneficiaries as possible while avoiding some taxation because the benefits are generally tax-free. So what is long-term care insurance? So it's insurance intended to pay for some or all of the long-term care expenses of the insured. I would tell you that most people that I work with on a daily basis, they're not looking to cover the entire amount, but they're looking to cover as much as they of the home care cost as they can. This began as early as the late 1970s, started out as nursing home only. Today's products are really designed to be very flexible, where you can use them for assisted living, you can use them in your home, you can use them for adult daycare. So they've really evolved to meet the consumer demand and really what's going on in the market. So they're covering a lot more services these days. So if we look at the common types of insurance that are available in today's marketplace, you've got traditional long-term care. Some people think of that as pay as you go. Then you've got asset-based life and long-term care insurance. And then the third option being life insurance with either a long-term care or chronic illness accelerated death benefit rider. We're going to talk about each of these a little bit more in depth and discuss some of the pros and cons of each of them, because let's face it, every plan has its own pros and cons. And what we all as consumers need to figure out is which one looks and feels the best to us, and is that something that we want to pursue? So when we look at traditional long-term care, you generally are going to have lower premiums than other types of insurance. And there's reasons why, right? There's some features and benefits with other plans that traditional long-term care doesn't have. It does increase the funds available to cover your expenses. So you're offloading some of that risk onto the insurance company. So again, it'll help keep those retirement assets from being liquidated at an inopportune time, or at least you can mitigate the impact of that. And with inflation options, you can increase your benefits over time. So when you think of traditional long-term care, the example I always give is think about your homeowners or your auto insurance, right? The rates can and usually do change year in and year out, at least at some point. But there's, at the end of the period, so at the end of a given year, if you decide to walk away, you're not gonna walk away with anything. There's no return of premium, if you will. Some policies will offer a rider that says if you pass away prior to age 65, you'll get a return of your premium as a death benefit, but you have to pay extra for that. So it certainly has its advantages in terms of the cost, but as we look at the disadvantages, these are usually designed with ongoing premiums, sometimes paid over the lifetime. As I mentioned, the rates can and usually do go up over time, and you may find that those increases come more often the older you get, as the insurance companies sometimes try to encourage folks to get out of the plan. And if the long-term care is never needed, that money is spent, it's gone. As I mentioned, there's no return of premium, and there's generally no death benefit. So especially if you get past age 65, for the products that offer a return of premium, if you pass away prior to 65, once you get to 65 and beyond, there's nothing there. If we look at the asset-based life and long-term care insurance, these are policies that are built on a life insurance chassis, but the real goal here is long-term care benefits. So some advantages with these types of plans are the premiums are guaranteed. And when we talk about guaranteed in the sense of insurance, we're talking about that they're not going to change. So you're not going to have rate increases. These products can be sold via a single premium, or paid for via a single premium, or paid for over time. But even if you pay it over, for example, 5 or 10 years, you don't have to worry about the rates going up. If the benefits are not needed, there's a death benefit that will be paid to the beneficiary, or you can surrender the contract and get some degree of return of premium. Depending on the carrier and the product that you use, you may get a portion like 70%, for example, in the return of premium. There are others where you can get all your money back if you've never used any of the benefits. And the cash surrender value remains an asset on your balance sheet, and you typically are going to have inflation options. Inflation options will vary in terms of what makes the most sense based on your gender and your age. But usually we're putting inflation on these types of plans so that the benefits will grow over time and try to help you keep up with the rising cost of care. In terms of disadvantages, you're generally going to see higher premiums on these types. So just to give you a sense, the single premiums, you might see premiums of 75 or 100,000 in a single premium, or maybe, 5,000 a year for 10 years or 10,000 a year for 10 years. So you're going to have a higher premium. There's a difference between premium and cost because, again, if you've got return of premium, that's not all cost, right? So it's important to keep in mind the difference between premium and cost. And the death benefit is usually equal to what the premium paid is, as is the return of premium. So the reason that's listed as a disadvantage is you're not going to have growth, right? Even if you have a product that has full return of premium, if you put in $75,000 today and decide to cancel it down the road, there's no growth on that money. If you exercise your return of premium benefit, you're going to get what you put into it. And it's not going to have a large death benefit. Again, the death benefit on these products is really there to address the use it or lose it concern that is typically associated with the traditional long-term care. So it's there really just to make sure that the premium that went in is going back to the beneficiaries if it was not used by the insured. Lastly, if we look at the life insurance with the LTC accelerated benefit rider, this is going to accelerate a percentage of the death benefit in the form of long-term care. You're going to have flexible payment options, right? So if you decided at age 45 or 50 that you wanted to buy this, you could do it and where you pay over 5 years, 10 years, 20 years, 30 years. You can really tailor it to whatever works for your budget. You're going to have a higher death benefit amount because these types of plans, the death benefit is the primary focus. And as I explained it to people, the oh, by the way, is, oh, by the way, if you need money to offset the cost of long-term care, you can tap into your death benefit. And it's usually based on a percentage of either 2% or 4% of the death benefit. On the downside or the disadvantage side, as you're using long-term care benefits, you're also reducing the potential death proceeds that would go to your beneficiaries. Because a lot of people will buy this for the primary need of having some death benefit protection. So you'll erode that as you start using it for long-term care. You have to qualify from both a life insurance and a long-term care insurance perspective. And that applies to the asset-based plans as well. And with the life insurance, you're going to get a flat percentage of the death benefit. So you're not going to have inflation to help you keep up with the rising cost of care. So with these plans, as I mentioned, it's usually either 2% or 4% of the death benefit that's being paid out. So for example, if you opt for the 4% option, it will last 25 months, right? 25 times 4 is 100%. If you wanted to go with the 2% option, it would last 50 months, and then you would exercise all the benefits. So if we look at this in terms of the spectrum, right? Where do we get the most long-term care per premium dollar? And then where do we get the most death benefit per premium dollar? You're going to see traditional is on the left-hand side, where pound for pound or dollar for dollar, you're going to get more LTC benefit with the traditional. Keeping in mind that there's a reason it's lower because there's some benefits that it doesn't have. Whereas on the death benefit side, you're going to have that life insurance where this is a permanent cash value policy, like a universal life or a whole life policy with the accelerated benefit rider. So that one's going to provide you with the most death benefit. Whereas the asset-based is kind of right in the middle. It's going to offer a decent death benefit in terms of your money will not be wasted. A lot of people think, geez, what if I put all this money in and it's wasted because I pass away before I need the benefits? That doesn't happen with those plans. But it's also going to give you a fair amount of long-term care, especially with inflation built into the contract. So as you design the long-term care plan, there's a few things that you have to take into consideration. And a lot of these are what I would call million-dollar questions, because we simply just don't really know what the number is going to be or the answer is going to be. So for example, how much LTC benefit might I need? Well, that's kind of a guess, and there's some industry information we can look at. For those of you who have a pen and paper, if you want to write down Genworth cost of care, right? If you just did a Google search on Genworth cost of care, it'll bring you to a website where you can actually enter a city and state, and it will tell you the median costs for different levels of care: home care, facility care, private nursing home, semi-private. And then you can go out into the future and make an assumption on an inflation rate. So that'll at least help you get your arms around what might the numbers be for me in my area, or if you're currently living in Western Mass but thinking, geez, I might retire down in Florida, you can look at different parts of the state, but we've got to consider how much benefit we might need. How long can you expect benefits to last? There's been some studies done by the Department of Health and Human Services where, for people who are going to need help with 2 of the 6 activities of daily living, they're projecting that people that are 65 today, women will need care. About 25% of women will need care 5 years or longer, and about 18% of men will need the care for 5 years or longer. And those projections are growing. So we have to take that into consideration. When do I expect I might need long-term care? We know statistically and historically about 2/3 of all claims happen at age 80 or later. So if you're trying to think about a plan and looking at your assets and how you might pay for this, 80 is usually the number that we focus on in terms of when most people might need care. How long do you have to wait for the benefits to begin? So that'll be reflected in terms of an elimination period. So if you do end up purchasing some sort of long-term care plan, the elimination period will tell you how long you'd have to wait before you'd actually be able to access the benefits. And lastly, will you have support to guide you and your loved ones through that process? Today, most policies will give you access to some level of what we call care coordination, where you can work with someone either at the carrier or a third party that the insurance carrier will contract with, that will assist the client with getting through the claims process, getting approved and on claim, assistance with writing a formal plan of care, and lastly, identifying care providers in the local area. So again, most contracts or policies will have some degree of care coordination available to you, which I think is a big part of the story, because when we get to that now what moment, and I say now what because I've been through that with my parents, where, okay, mom fell and broke her hip. Okay, now what? Who do we call? What do we do? How does this all work? So when you get to that now what moment, there's someone that you can work with who would be an advocate for you and help you through that process, because it can be frustrating and time consuming and not the most pleasant time. So it's nice to have someone there who does this for a living to help you. So I would say start planning now. The sooner we do it, you can lock in rates while you're younger and presumably healthier, which will not only increase your chances of approval, but also because a lot of these plans are based on life insurance and they're age-based rates, the younger you do it, the better the rates are. And if you have inflation options on a policy, it gives those inflation options more time to drive the benefits up. Again, higher insurability, generally speaking, the younger you are, better rates and more time to drive that benefit up. The longer we wait and kick the can down the road, the less benefit you'll get, and you run the risk of either finding yourself unable to get a policy, or at least having to wait because of things like maybe a cortisone injection or a joint replacement or some sort of physical therapy that could delay the process. So it's always better to start sooner rather than later. So with that, Al, I'll wrap it up, and I'll toss it back to you to see if you've got any comments, and certainly any questions anyone may have. I'm more than happy to take those as well. So Al?
Dave, as always, well thought out presentation. I did see one question appear in the chat, and that had to do with, can you explain death benefits as they relate to these policies?
Sure. Let's see here. So the traditional policies, generally speaking, are not going to have a death benefit. Usually, depending on the carrier, there is a rider that you can purchase on the policy for an additional premium that will, let's say I bought a traditional policy and I were to pass away prior to age 65, that rider would return all the premium that I paid into it to my family in the form of a death benefit. The asset-based products and the life insurance with the rider, these are both built on life insurance chassis. And so they do have a death benefit associated with it. The asset-based policies, the death benefit is usually going to be equal to what was put in terms of premium, because the idea behind it is to, with the asset-based policies, is to replicate the idea of self-funding. So if I'm going to self-fund and I'm going to take 100,000 and put it into a money market account or a savings account, if I never need that care and I pass in my sleep, like candidly we all hope to, that money's still going to go to my beneficiaries. And so we offer the death benefit on those asset-based plans because we're trying to replicate the idea of self-funding, so that if a client were to purchase one of those plans and pass away before using any benefits, that premium will then go back to their beneficiaries. The life insurance with the rider, that's typically going to be a larger death benefit, for example, 250 or 500,000, usually driven by the fact that the client has a need for death benefit, whether it's income replacement, they want to pay off their mortgage and make sure the kids go to college, but they can use that death benefit in the form of long-term care. So if they never tap into the long-term care and they pass away, all 250 or 500,000 will go to the beneficiaries. But if they do go on claim, the death benefit will be reduced by the amount of benefits used. And that's going to apply to both the life insurance with the accelerated benefit rider as well as the asset-based long-term care.
Excellent. I did get a question, and I'm sure you've come across it all too often, is when is the best time, or rephrase, when is the latest that one should consider purchasing a long-term care plan?
So the latest is really going to be based on the carrier and what they allow in terms of their maximum age limits. So for example, Pacific Life, we were normally at age 75. We reduced it to 70 due to COVID, and it hasn't gone back up yet. There are other carriers that go as high as age 80. I believe that's the highest age that I've seen. I would say that, you know, a lot of people that are buying the asset-based products, which I represent, they're usually right around age 60, plus or minus a couple of years. And I think the ages are starting to creep down a little bit more because, again, just my opinion, but what I hear and see a lot is people who are in their mid to late 50s have parents that are around age 80, and they're seeing the impact financially, as well as just the impact on them, and having to set aside time to help their parents with whatever they need help with. And so they're starting to get an increased level of interest because they're seeing the impact and they're becoming more educated on what's available. And they're now understanding that there are products with guaranteed premiums, so they don't have to worry about getting those rate increase notices. And they're understanding that there are products where they can put in a large sum of money and literally able to take all that money back at any point. So they're much more open to the idea. And I think people are also cognizant of the fact that, you know, longevity is going to lead to more people living longer and living longer with chronic illness. I did see a question in the chat. I now have the chat open where there was a question about the difference between premium and cost. So I'm glad this was asked because I did want to go into this a little bit deeper. So I mentioned on the asset-based long-term care, there is an option where you can get all of your money back, right? So if I were to buy a policy and let's say I put $100,000 in and I can take all my money back at any time, I essentially still control that money. My net worth hasn't changed. I've just moved the location of the money from the savings account or the checking account to the insurance carrier. So because I still have control of all that money, I haven't given up the money. I've just repositioned it. The only thing I've given up is the ability to earn anything on it.
Yeah.
And so, Al, I'm going to throw a question back to you that you're not expecting, but I think you'll be able to answer this. If I was sitting in cash today and I was contemplating getting the long-term care, and we think about what we're earning on cash, what would I be earning in today's interest rate environment if I had 100,000 sitting in cash?
To point to the question as it relates to what the interest rates are right now, and just talk of a rising rate regime, but presently, you're earning on that $100,000 in cash, perhaps no more than 0.25 or a quarter of a percent on that money. So the opportunity cost of which you're making reference to by investing it other than purchasing, such as we're describing here in the long insurance and long-term care program, is that quarter of a percent is what we're giving up in consideration for what potentially could be a significant event and costs associated with it in the future.
So thank you. And so a quarter of a percent on $100,000 is $250, right? So that's the cost of doing the long-term care. So when I say there's a difference between premium and cost, the premium is undoubtedly a large number, 50,000, 75, 100,000, even whatever it may be. But the cost may be a very low number depending on where the money is currently sitting. So I always think it's important because I think a lot of people view long-term care as being expensive. And when you think about it through that lens, it all of a sudden does not seem very expensive at all because, I've asked the question before, would you forego that $250 of interest if we could show you a way to protect 300, 400, 500,000 of your assets should you find yourself needing care down the road? And most of the time when I pose that question, people are like, yes, absolutely, because $250 is not going to change anything in my retirement plan. 300, 400, 500,000, that's a much different conversation.
And Dave, I'm sorry, I continue to see some questions dropping into the chat, and one of them has to do with discounts available if couples were to purchase.
Yes, so we most of the contracts today have some sort of couples discount. And the couples discount is really driven by whether or not the state recognizes the couple. So, traditional marriage, same-sex, civil union, domestic partnership. If the state recognizes it, then the carrier will recognize it. I will point out that with most carriers, it's not, the discount is not dependent on how many applications we receive. So, for example, if we had a husband and wife, and let's say the husband had a bad back and was continually getting physical therapy and just was not going to be insurable, his wife, if she were to apply and get approved, she would still get that couple's discount. And the reasoning behind it is the carriers feel that if there's someone that's in that kind of committed relationship, the claims experience will be better for the carrier. So we try to pass those savings on to the clients. So the age gap doesn't matter. I see there's a question about a 15-year age gap. The age gap doesn't matter. It's just whether or not you're in that state recognized relationship.
This is a two-parter. Is the premium larger if you wait, and can you change the plan over the course of time?
So to get the same benefit at age 60, for example, versus age 50, it's going to require more premium. So yes, the longer you wait, the more premium will be required to get the same benefit. So again, that's why we tell folks, start thinking about this sooner rather than later, because in addition to having lower rates based on your age, your insurability is typically better the younger you are in terms of getting approved, and then certainly the inflation giving it more time to drive the benefits up. And then the second part, Al, was that can you change the benefits once the contract's enforced? So we don't, most of the contracts, I don't think any contract would allow you to change the terms because it is a contract. So it's a written legal document. And that's, I can understand why people may want to do that, because they may go into it buying for example, a 6-year benefit, but if they realize that, hey, you know what, this may be a shorter claim, can I go shorter and get a larger monthly benefit? Unfortunately, we're just not there yet. I don't know that we're ever going to get there. So no, the easy answer is no. I see a question about, can you get all your money back? So I think we talked about that, but just to confirm, on the traditional, generally speaking, no, only if there's a death prior to 65 and there's a rider available. On the asset-based, you're typically going to either have a percentage, for example, 70% to start. Others, like Pacific Life, has a 100% return of premium option. The life with the rider, depending on the type of contract that you buy, the surrender value may grow over time to the point where you could get what you put into it. You're going to see the most growth typically in what's called a variable universal life contract, where you've got some market exposure with the cash value. Generally speaking, a universal life policy is probably not going to get to full return of premium. A whole life contract certainly could, depending on the interest or depending on the rates and any dividends that may be provided. But if you want the full return of premium, Pacific Life is currently the only contract that provides that day one.
Since we got it.
Yeah.
Love the
Hey,
questions.
There's a question arising from, can you give an example of what it would look like for an asset-based long-term care? Do you need a significant amount of money to go into the plan in order for that to, and what might that look like in the upfront, as referenced here, the upfront cost, so the initial premium?
So it's really going to be dependent on the age and gender of the client, which inflation option. So I would tell you that here in the Northeast, we typically see an average premium of about $80,000. So that could be in a single premium, or it could be paid over a 10-year premium schedule. So maybe $8,000 a year. And I see there's a question about an average premium per year. So that's what we're seeing. But if you looked at a traditional long-term care policy, you might see that annual premium drop to $3,000, $3,500, somewhere around there. I'm just not as in tune with those rates because that's not what I sell. But I know they're usually significantly less because, again, it doesn't have a death benefit. It doesn't have return of premium, and the rates can go up. So the rate that you get today at, for example, $3,000 is most likely not going to be the rate that you're paying 10 or 15 years from now.
In regards to a individual having what they consider to be a significant amount of life insurance, what wouldn't traditional long-term care be a good choice?
Let's say I just want to read it. If I have excellent life insurance coverage already, wouldn't traditional? So traditional could be a good choice. Again, just depending on cash flow and your financial situation. I would just, the only caution I would say is keep in mind that, especially if you're young, the rates can and usually do go up. And we're not usually seeing single digit percentage-wise rate increases. We're seeing rate increases today on policies that were sold years ago, where you might see 120% increase over a 3-year period. You might see a 75% increase in 1 year. Because what happens is the insurance companies will go to the states, and they've done their calculation, and they're going to go to the states and request a certain percentage increase. And the state will either approve it, or they're going to deny it and maybe give them a response with, we're not going to give you what you're looking for, but we'll give you this amount. And then at that point, the insurer or the insurance carrier will then determine whether or not they want to consider offering coverage in that state. So there are situations where insurance carriers just won't offer coverage in a given state because they haven't been able to get the rate increases that they feel that they need. The other thing that I would say about with the question with excellent insurance coverage already, and I don't know, what the person's situation is, but one of the things that we see fairly often these days is we get folks that are getting into that 60-year-old age range, and they've got some old cash value life insurance, and they're saying, geez, Al, I'm not so concerned about a quote unquote premature death today like it was when I was 30 years old and I had a couple of young toddlers and a mortgage and everything else. I've had some time to build up my investment portfolio. I've got my 401k. I think I'm in a pretty good spot. I'm more concerned about this issue of long-term care. So you can actually repurpose the cash value of an existing life insurance contract, and you can do an exchange into either an asset-based plan or the life insurance with a rider. So for a lot of folks, the life insurance protected them during their working years, and now that they're getting toward the retirement years, they're looking to say, you know what, I want to repurpose that and protect against long-term care, because most of the advisors that I work with, and that's my direct client is financial advisors like Al. They tell me that most clients, their one exposure in their portfolio is what happens if we find ourselves sick or injured and need care over an extended period of time. And that's the one thing.
I do see a few more questions, but I would like to ask of you to spend just a moment or two about what happens when you go on claim.
In terms of the process to go on claim.
Yes.
So as I mentioned earlier, most carriers are going to have some degree of care coordination where there's someone who will help you through that claims process. For example, with Pacific Life, we've actually contracted with a company called the Long-Term Care Group. If anyone cares to do any research, their website is ltcg.com, LTCG, as in Long-Term Care Group. And we've partnered with them because they have a lot of experience in this space and they assist us with both underwriting and claims administration. And so as a client, I would call in and I would give them my name and policy number. And they're going to ask why I'm calling. And I'm going to tell them, I was either diagnosed with Alzheimer's or I was in a bad ski accident or car accident. And they'll start asking me questions. And as I'm responding, they're going to be filling out the paperwork on my behalf. Once we complete that conversation, they're going to send it to me to allow me to review it for accuracy. And they're also going to reach out to my physician to get my medical records. Once they have all the information, they're going to give it to a case manager who is going to review it. And that case manager is able to certify that I'm chronically ill. My own physician can certify that I'm chronically ill. And candidly, we don't really care who does. We just want to make sure that the certification is accurate. So once we get that certification, we will then develop a plan of care. And with any formalized long-term care plan or long-term care insurance, you have to have a plan of care, which will outline the types of care, the number of hours, et cetera. They'll review that with the insured, the power of attorney, the family members, et cetera. And at that point, they will also help identify care providers in the local market. So for example, who's available in Western Massachusetts, or if I decide that I'm going to retire, south of the Mason-Dixon line, and I'm not really sure, they're going to be able to do the research for me. We do not tell our clients who they have to hire. We let the client determine that on their own. We just help them in terms of letting them know what kind of care providers are available. So we try to remove as much of the stress as possible because, again, it can be a frustrating and stressful and time-consuming aspect of the situation.
Dave, much appreciated. Let me ask Josh, do we have a additional time? Because questions are continuing to pour in.
Yep, we have as much time as you all need.
All right, Dave, you're good to go. All right. I think you answered one of the questions having to do with if I purchase in one state and move to another, how are my benefits affected, if at all?
The contract language actually references cross-border rules. So if, for example, if you bought a policy today in Massachusetts and retired to North Carolina, you could use that same contract in North Carolina. So that's not a problem. I'm seeing a question on here. Our reluctance to purchase has hinged on the 2 of the 6 conditions. Neighbor had LTC, and despite inability to leave her house to walk more than 20 feet or shower, she could not activate the LTC. It would be interesting to know how many applications for activation of LTC after purchase are rejected. Our impression was that the insurance companies have fought tooth and nail not to pay out. I've certainly heard that sentiment from a lot of people, and I think a lot of that stems from the old traditional plans, especially the older ones that had unlimited benefits. That's not something you generally see in the market. There is one carrier out there that has unlimited benefits, but the older policies, a lot of them had unlimited benefits. And so the carriers were looking for any leg to stand on to not pay out benefits, because once they started, they couldn't turn the spigot off, if you will. And that's one of the reasons why insurance carriers are experiencing such high rate increases, is because they built and priced the products at a time where interest rates were more favorable, so they could earn more money. They were building in higher, what we call lapse ratios. So they were assuming that for every 100 people that bought the policy, there would be a fairly substantial number of people that would cancel the contracts. And what's happening is people are not giving them up. They're finding a way to pay the premium because they understand how expensive it's going to be. So people are not lapsing their policies. Interest rates have dropped and people are living longer and living longer with chronic illness. So today's products, for example, the asset-based plans, there's a return of premium. So if the consumers, if the consuming public felt like the insurance carriers weren't going to provide the benefits or make it challenging, they would probably start cashing in the policies, and we're just not seeing that. And then the life insurance with the rider, most people are buying that for life insurance first, so they're still going to have that. So I certainly understand the sentiment and the concern, but again, when you've got return of premium, if there's a sense that the insurance company is not going to pay out, you can simply walk away. In terms of the 2 of the 6 activities of daily living, I think that's a situation where, the client, someone needs to be an advocate for the client, or they need to advocate for themselves to their physician that I can't do this. I can't get up and feed myself, or I can't get up to bathe myself. So I know every situation is going to be unique, but I would just say that I think the policies are a little bit different today in terms of some of the embedded protections for the clients. So hopefully we don't see that kind of objection going forward as much.
Dave, there is a question regarding the period of benefit coverage. Is it unlimited or is it for a certain period?
So most of the contracts are going to have a duration limit on them. So for example, on the asset-based plans, if you were to get a quote, you're going to see that it will list a monthly maximum benefit. So for example, a common duration would be a 6-year benefit. So I always tell folks, think of that in terms of 72 months, right? Six years is 12 months per year times 6 gives you 72 months. So if you use the entire monthly maximum benefit, month in and month out, it will last 72 months. If you use less than your monthly maximum benefit, it will extend the duration. If you did the life with the rider, the life insurance with the LTC accelerated benefit rider, if you're using the 4% option, it's going to last 25 months using the entire amount. But if you use less, it will last longer. So most of the contracts will have some sort of embedded maximum duration, but it'll be based on using the maximum amount in a given month. And it could extend from there if you use less than that. I see that there's a request to repeat the website that I was referring to. So again, if you just do a Google search and you type in Genworth, and that's G-E-N as in Nancy, W-O-R-T as in Tom, H, Genworth, cost of care. In fact, I'll do this. I will. So this is what the website looks like. I'll just make it a little bit bigger. So for example, you can enter South Hadley, Massachusetts. And if we go back here and we click on the annual tab, it will show you the annual cost for different levels of care. And it'll also show you the change in the cost from 2020 to 2021. So you can see home care had a pretty substantial increase for the median. I'm sorry, oh, this is showing national. Let me make sure this is going to, here we go. So this is now South Hadley. So it's pulling in information from Springfield because that's the closest large city. So it was about a 10.3% increase for home health aid. Make that a little bit bigger. Whereas facility care was still in the single digits. Adult daycare had a substantial increase at 46%, whereas assisted living dropped by 12.2%. So knowing that we've got different levels of inflation, if we run this out 20 years and we choose a 4% inflation rate, you can see that home care is going to be around $150,000 a year. So if we find ourselves needing care for a 5-year duration, that's about $750,000 net of any taxes, 15 to 20 years into retirement spending. So it's one of those things where you kind of need a glass of water to get that pill down because it's a big number. And so that's why we think it's so important to have these conversations and put a plan in place so that you can get some benefits to help offset this. Because just using round numbers, let's say if we did a long-term care policy where we put in 100,000 of premium, whether it's a single premium or paying it over time, and let's say the benefits at age 80 are 400,000. If I were to go on claim at age 80 and use all 400,000 over a 6-year duration, I would have put in 25 cents for every dollar of care that I received. Whereas if I choose to self-fund, I'm going to pay dollar for dollar using cash. But if I have to take money from an investment account, I'm going to have some level of taxation in addition to potential market volatility and sequence of return risk. So, these numbers can be a bit staggering. And if we break this down to a monthly number, you're looking at about $1,000, I'm sorry, 12,000 per month, 20 years from now. And that's the median. So not the best, not the worst. And another tool that's on this website, if you click on this trends and insights, it will bring you to a page where you can look at where a given state would rank amongst all the other states. So for example, if we look at Massachusetts, I'm going to start up here. For homemaker services, it's the 7th most expensive state in the country. And then if we, let me go back up to home health aid, where Massachusetts is the 8th most expensive. If we go to adult daycare, we get a break and Massachusetts drops down to number 39. But if we go to assisted living, Massachusetts is the 4th most expensive. Semi-private nursing home, it's the 4th most expensive. And private nursing home, it's the 4th most expensive. And you'll notice a lot of the Northeast states are in the top 10. So there's a lot of great reasons to live up here in the Bay State, right? We've got the Sox, we've got the Patriots, the Bruins, the Celtics. We get the change of seasons, but cheap healthcare is not one of them.
Dave, a two-parter having to do with, can you pay a lump sum and continue on to lower the balance of payments and pay it out over a duration? And also, can you use your 401k to purchase LTC?
So there are some products allow for a larger lump sum in the first year and then smaller ongoing payments. So that is an option. And everything that I'm talking about, this is all stuff that Al can help you with, because being an independent financial advisor, he has the ability to sell all the carriers. So that there is the ability to do that. We can't take dollars from the 401k without paying the IRS their fair share. So if you're taking money from a retirement account, you would have to pay the taxes first, and then you could use the money to pay the long-term care.
Thank you. If a company who is offered long-term care decides to remove themselves from the marketplace, what happens to those existing policies, to the best of your knowledge?
So typically when a carrier gets out of a line of business, they will set up another company that will just manage those in-force policies. For example, I have an old Hartford life insurance contract. The Hartford created a company called Talcott Mountain Resolution Company or something like that. So it's a separate company that just manages the in-force block of business. So that's most likely what would happen. If there was a question of insolvency where the insurance carrier got into financial trouble, every state or every company that does business in a given state belongs to something called the State Guarantee Association. So, for example, you can go to the website is N as in Nancy, OLHGA. That stands for the National Organization of Life and Health Insurance Guarantee Associations. So you could go in and you could do a search, for example, for Massachusetts, which would then take you to their website. And then if you click on the frequently asked questions, there are questions like, are the policies fully protected? And it'll list the limits that they'll cover for different types of policies. What I would tell you is, while none of us has a crystal ball, I don't believe there's ever been a situation where a company became insolvent and there wasn't a buyer that was found. But if that situation did come to fruition, the State Guarantee Association would step in and take over those contracts.
I don't see any further questions at this time. Let me just leave with the thought, and Dave, thank you again for the excellent presentation. If there's questions on any of the attendees that would like to see perhaps an illustration of what their possible strategy might look like, I'd be most happy to do so. And I guess, Josh, will have to have them contact you directly for that information. And let me now turn it back to you. And if there's anything further, please let us know.